Happy Monday. It is February 16th, 2026. If you woke up this morning, grabbed your coffee, and immediately tried to log into your brokerage account to see if the bleeding stopped, only to realize the numbers aren't moving.
Don't panic.
Don't panic. It is President's Day here in the U.S., and the markets are closed.
Which, honestly, considering the absolute whirlwind we just lived through last week, might be the best thing that could happen. We all need a timeout.
A timeout is exactly what the doctor ordered, because if you were watching the ticker from February 9th through the 13th, it felt like the market was trying to gaslight us.
That is the perfect way to describe it.
Yeah.
It was cognitive dissonance in real time.
Exactly. So we have a massive stack of research to get through today based on the latest weekly market outlook. And our mission is, well, it's pretty simple. We need to solve a paradox. We just lived through a week where the economic report card, the actual data on how the U.S. engine is running was spectacular. I'm talking A+, pin it on the fridge material.
It really was. If you just looked at the economic data, you'd assume we were in the middle of a massive boom.
And here's the twist that has everyone freaking out. The stock market treated this good news like it was radioactive. Stocks fell across every single segment.
Yep.
Okay, let's start with the good news, because I feel like we need to appreciate just how weird this is. The economy is supposedly on fire. What kicked this all off?
It all started last Wednesday. Remember, the jobs report was delayed because of that partial government shutdown, so the anticipation had really been building for a while. The market was edgy.
Right. And when the numbers dropped, they didn't just beat expectations, they absolutely crushed them.
Crushed is the right word. The headline number for non-farm payrolls came in at plus 130,000. Now, the consensus, the average guess of all the smartest economists on Wall Street, was 65,000.
So we literally doubled the expectation. That's not a rounding error.
It's a massive beat. And that 130,000, that's the best reading we've seen since, December 2024? But, and this is where you have to put on your detective hat, the headline number actually underplayed the strength.
How so? Usually the headline is the rosier number.
Not this time. You have to look at private payrolls. This strips out all the government hiring and tells you what actual businesses are doing with their own money. That number came in at a staggering plus 172,000.
Oh, wait, hold on. The expectation for that was way lower, right?
The expectation was 68,000. So we beat that by more than 100,000 jobs.
That is wild, but I want to contextualize this for you. Is 172,000 a lot historically, or are we just, recovering from a slump?
No, it represents a violent shift in the trend. If you look back at the entirety of 2025, the average monthly growth for private payrolls was anemic. Barely a pulse, about 30,600 jobs per month.
Okay, let me do the math here. We averaged 30,000 a month last year. We just posted 172,000 in a single month.
That is 5.6 times the 2025 average. It suggests that businesses have stopped sitting on their hands, stopped worrying about a recession, and are now aggressively expanding.
Which brings us to the inevitable scary word, inflation. Usually when the labor market gets this hot, the Federal Reserve breaks out in cold sweat because more jobs mean more spending, which means higher prices. Did this report trigger an inflation panic?
You would think so. That's the standard playbook. But that's the second part of this paradox. We got the CPI, the Consumer Price Index, on Friday.
Yeah.
And it was remarkably boring.
And in the world of economics, boring is beautiful.
Exactly. The CPI actually surprised to the low side, coming in up just 0.2%. But the real star of the show was the core CPI, which, strips out food and energy. Year over year, we're sitting at 2.5%.
And that's a big deal because
it's a 5-year low. We have not seen inflation this manageable since before the whole post-pandemic spike. So you've got the Holy Grail, booming job growth, and cooling inflation.
So the Fed isn't cornered. They don't have to hike rates to cool the labor market because inflation is behaving.
Precisely. In fact, they have more room to cut. Because of that mild CPI report, the market's expectations for interest rate cuts in 2026 actually jumped up.
Oh, really?
Yeah, the probability that we see cuts totaling more than 50 basis points, so more than 2 standard cuts, went from about 41% to over 49%.
So basically a coin flip that we get deeper cuts.
Right. And investors are still pinning the first cut for June, but the conviction is stronger now.
I do want to throw one little splash of cold water on this party, though. I saw the retail sales data from last Tuesday. The headline said 0% growth. That sounds stagnant.
It does. It looks like a stall at first glance. It missed expectations of 0.4%. But you have to remember, retail sales are notoriously noisy. One bad month of auto sales can skew the whole thing.
Okay, so let's summarize the Main Street reality. Jobs are exploding up 5.6 times the average. Inflation is at a 5-year low. The Fed is likely to cut rates, and the consumer is holding the line. In a rational world, the stock market should be popping champagne corks.
It should be green arrows as far as the eye can see.
But instead, it threw a tantrum. Let's pivot to the carnage. How bad was the sell-off last week?
It was ugly, and it was broad. I mean, if you look at the scorecard from February 9th to the 13th, there was almost nowhere to hide.
Yeah.
The NASDAQ took the brunt of it, down 3.0%.
Ouch.
But it wasn't just tech. Growth stocks generally were down 3.1%, large cap down 1.8%, small cap down 1.6%. Even value stocks, the boring, safe stuff, were down 0.5%.
So even the defensive plays lost money. Okay, help me understand this. Usually when the market tanks, we blame the Fed. We say, oh, rates are too high, money is too expensive. But we just established rates are likely coming down, so we can't blame Jerome Powell this time. What is the driver?
No, you can't blame the Fed. This is entirely about a narrative shift in the tech sector, specifically anxiety about artificial intelligence.
We've been riding the AI wave for years. Is the wave finally crashing?
It's not crashing, but the bill is coming due. For the last 2 years, the story was AI is the future, buy the chips, buy the infrastructure at any price. Now, investors are looking at the capital expenditures, the CapEx.
The actual cash these companies are spending to build all this stuff.
Exactly. And we were talking about hundreds of billions of dollars on data centers, energy, custom chips. And last week, the market started asking a very uncomfortable question. Where is the profit?
It's the Jerry Maguire moment, show me the money.
Precisely. And the source material uses this really interesting phrase to describe this specific fear. Success in share, failure in profit.
That sounds like a business school case study. Break that down for us. What does success in share, failure in profit actually mean in the real world?
Okay, think about it like the airline industry in the 20th century. Everyone knew air travel was the future. It took massive market share from trains and ships. But for decades, airlines were terrible businesses because the competition was so fierce and the capital costs were so high that nobody made any money.
So the fear is that AI is the new airline industry.
That's the worry. The market believes AI will work. It'll take market share from software companies, logistics firms, media. But investors are now doubting whether the companies building the AI can monetize those gains enough to justify the trillions they're spending. If you spend $1 to make 10 cents, you win the market, but you go broke.
And that fear is why the Magnificent Seven got hammered.
You were the epicenter of it. These stocks have been treated as these invincible safe havens. Last week, they looked very, very mortal.
Who was the biggest loser?
Apple. It plunged 6.86% in a single week.
Almost 7%. For Apple. That is a massive move for a company that size.
It's huge.
Yeah.
Microsoft lost nearly 3%. In fact, out of the entire Magnificent Seven, only Tesla managed to stay flat. Everyone else was down significantly.
It feels like the market is just holding its breath. Is there a catalyst that can fix this, or are we just going to bleed out slowly?
We are absolutely holding our breath, and the catalyst is coming next week. We are all waiting for NVIDIA.
The king of the AI chips.
They report earnings next week. They are the last of the Magnificent Seven to report. And in many ways, NVIDIA is the litmus test for this entire profitability narrative.
Because they're the ones selling the shovels in the gold rush.
Exactly. If NVIDIA shows weakness, or if their guidance suggests that their customers, the Microsofts and Googles of the world, are slowing down their spending because they're running out of cash, this anxiety could turn into a full-blown panic.
So the fate of the entire market is resting on one earnings call.
Effectively, yes.
Okay, so tech is scary. But usually, when one part of the market gets expensive or scary, investors rotate. They find the bargains. I feel like for the last year, I've been hearing, small caps are back. Is that trade working?
That's the other nasty surprise in this data. For a while, that was true. Back in October 2023, small caps were trading about 23% cheaper than their historical average. It was a great entry point.
And now?
Now they're trading 32% rich or expensive compared to history relative to large caps.
Wait, how did they get expensive if they haven't been performing that well? The prices didn't just skyrocket.
It's the denominator problem, the E in the PE ratio, the earnings. Small cap earnings have been terrible. So even though prices didn't moon, the companies just aren't making enough money to justify the price. They swung from being a bargain to being a trap.
So the buy small caps trade is dead.
According to this outlook, yes. They're advising pulling back on small cap overweights. It's just too expensive for the quality you're getting.
So where's the value? If I don't want AI risk and I don't want small cap junk, what's left?
Well, literally value stocks. The boring companies that make steady money. They're still trading about 19% cheaper than their historical average compared to growth stocks. So if you simply must be in the U.S. market, value seems to be the safer play.
You said, if you must be in the U.S. market, that implies there's another option. How are we doing compared to the rest of the world?
This is the stat that made me spit out my coffee when I read the report. We are so used to American exceptionalism in the stock market. But look at the scoreboard for 2026 so far. The S&P 500 is sitting flat, basically 0% return year to date.
Just spinning its wheels.
Meanwhile, developed market stocks, Europe, Japan, are up 8.6% this year. And emerging markets, they're up a massive 11.7% year to date.
Wait, emerging markets are beating the S&P 500 by almost 12% in 6 weeks. That is an enormous gap.
It's massive.
Yeah.
And usually when you see a gap that big, your first instinct is to check the currency. You assume the dollar must have crashed, making foreign stocks look better in conversion.
Right. A weak dollar boosts international returns.
But the U.S. dollar is only down 1.3% this year. So that explains a tiny fraction of it, but not a 12% gap.
So what explains it?
It's the tech sell-off. The U.S. market is so heavily weighted towards those magnificent 7 tech companies. When they sneeze, the S&P catches a cold. The rest of the world isn't as exposed to that specific AI anxiety. They are benefiting from the global economic growth, which we know is good, without the heavy baggage of the AI capex fears.
That is a fascinating reversal. For a decade, the rule was stay in the U.S., stay in tech. Now it looks like go global, find value.
It's a harsh reminder that diversification actually matters. It's easy to forget that when one trade works for 5 years straight, but when the regime changes, it changes fast.
So let's follow the money. Investors are pulling money out of U.S. tech. They aren't putting it into small caps. Where is the cash going? Is it just sitting in money market funds?
It's a classic flight to safety, but interestingly, it's a very specific kind of safety. Money is pouring into bonds. Yes, Treasuries have regained their crown as the risk-free asset. With the inflation data coming in low and the stock market getting shaky, investors flock to government debt.
And when price goes up, yields go down.
Correct. The yield on the 10-year Treasury fell significantly last week, down 15.4 basis points to close at 4.05%.
4.05% on the 10-year. That feels pretty reasonable.
It's incredibly attractive right now. If you're an asset manager and you're looking at a stock market that feels like a casino with bad odds and a bond market paying you a guaranteed 4% with inflation at only 2.5%, that real return looks very cozy.
What about the other fear trades? Usually when people get scared, they buy gold or maybe Bitcoin. Did those spike?
That's the weird part. No. Both precious metals and crypto saw volatility spikes last week, but they actually retreated from their all-time highs.
Why is that? If I'm scared, shouldn't I want gold?
It seems like investors didn't want volatile safety. They wanted boring safety. Gold and Bitcoin can swing 5% in a day. Treasuries don't do that. When the VIX, the volatility index, jumps above 20%, which it did last week, people stop looking for upside and start looking for guarantees.
Let's pause on the VIX. Is 20% a magic number?
It's a psychological threshold. When the VIX is below 20, the market is generally complacent. When it crosses 20, it means investors are pricing in significantly more movement and risk in the near future. It's the market's way of saying, buckle up, turbulence ahead.
Okay, so let's zoom out and look at the whole board as we sit here on this holiday Monday. The economy is undeniably strong. Jobs up, inflation down. But the stock market is stumbling because it's terrified that AI costs too much and won't pay off fast enough. The U.S. is lagging the rest of the world, and investors are hiding in boring old bonds.
That is the state of play as of February 16th, 2026.
Looking ahead to this week, the markets open back up tomorrow. What's on the calendar that could change this narrative, or are we just stuck in this funk?
We have 3 potential game changers. First, and we've mentioned it, is NVIDIA earnings. That is the main event. It will tell us if the AI trade is just pausing or if the structure is breaking.
That's the binary event, boom or bust. What else?
Second, on Wednesday, we get the FOMC minutes from the January meeting that will give us the behind-the-scenes look at the Fed's debate. Investors will be scouring that text for any clues on the timing of cuts. If the Fed sounds more dovish, more ready to cut, that could put a floor under stocks.
And the third?
The PCE price index on Friday. We had the CPI last week, but the PCE is the Fed's favorite inflation measure. If that confirms the low inflation trend, it cements the case for rate cuts.
But if it comes in hot, if it contradicts the CPI?
Then all the good vibes from last week evaporate. It would signal that the inflation fight isn't over, and bond yields would rip right back up.
So just another calm, relaxing week ahead.
Not in this economy.
Thank you for listening to this deep dive into the market paradox. We will be back next time to see if NVIDIA saved the day or if we are all buying bonds.
Until then, keep asking questions.